Owen Murphy, Deputy, you have 10 minutes.
To both the witnesses, the reference for my question, Chairman, is pages 37 to 40 in the court booklet. But before I come to that, I just wanted to go back, Mr. Patton, to something you were speaking about earlier in relation to PWC and the dedicated banking unit that you have. Was this unique amongst audit firms at the time?
I believe we were the only firm in Ireland that had a dedicated banking practice. That's my belief.
Is that still the case?
That would be my belief, yes.
Okay. And within that unit you had, you said, a specialist banking, retail banking, treasury teams. But did you ever consider a specialist property lending team?
We would have had specialist credit teams, and those specialist credit teams if you take our corporate team, for want of a better word, we would have had specialist credit specialists who would be used to all corporate credits, and we would have had retail credit experience in our retail teams.
But no one with a particular focus on, say, property?
Well, property would have been a component of those, so they would have had a specialism, they would have had an expertise in the audit of credit arising from the types of exposures that fall in those, and property would be one of those exposures, but it would not be the only exposure. But we're talking about the expertise to audit credit, because that's what our job is.
Okay. And when the bank began to change its internal structures at the beginning of 2001, specialist property financing units, and in 2004 dedicated property unit, was there a discussion in PwC about changing how you might audit the bank's activities?
I don't know, to be honest, but what I do know is, and the reason I wasn't involved in Bank of Ireland in 2001, but what I do know is that we would always, and we do always, at the start of any audit, sit down and talk about the risks that apply to that audit. So therefore, when a bank starts to build up, as Bank of Ireland starts to build up considerable exposures in various areas, we would have ensured that our banking expertise was appropriate to audit the bits that we were required to audit arising from that, and that would have been paramount.
So your concern would have been that you had the necessary expertise to audit what the bank was doing, not necessarily a concern with the additional risk the bank may or may not have been taking on?
No, as I've said before, it's not our job to comment on the risk that the bank is taking on. It's our job to complete our audit to ensure that we appropriately audit risks of material misstatement in the financial statement, which we look back rather than looking forward.
So it wouldn't have been your responsibility to comment to the bank itself, but with people that inside your expert team looking at banks and looking at Bank of Ireland, would they have been commenting to themselves or to senior partners about what was happening in the bank, the changes that were happening, the increases in, say, concentration in property lending?
I can't comment on what people were thinking in themselves. I mean, all I can really comment here is on the audit of Bank of Ireland. And on the audit of Bank of Ireland, we would have discussed, at the start of every year, when we set our audit plan, we would have discussed the risks in the context of what we were required to do. And that's what we would have done.
Okay, but in terms of, have you looked at documentation from the time internal to PwC?
Yes, I have.
And would there be documentation, emails, for example, of people on the bank team discussing their own concerns as to strategies being pursued by the banks, separate to their role as an auditor to the bank and the risks that they might be concerned with in terms of auditing?
I haven't looked at all the documents over the period. I have looked on the file. Basically, what is on the Bank of Ireland audit file is work directed towards the audit of Bank of Ireland, and that work is directed towards the risks, and it's directed towards the audit of those material risks. We don't have a role in determining the bank's business model, and we do not do a critique on our audit file of those business models. And the reason I say that, and this is important, we're an independent set of auditors. It's not our job to get involved in the management or the running of the bank, and therefore we need to be very careful that we look at what we're required to look at, and that's what we do, and that's what our staff would be trained to do, and that's what we would see on our files.
Okay, thank you. The document I cited is a document from the Group Risk Office to the Group Risk Policy Committee on the 13th of December 2007, and I saw about property concentration in the group's loan book. So, as part of your audit, does it concern itself with these types of documents?
This is I think it's a GRPC minute. We would have seen the minutes of the GRPC. GRPC is a very important risk committee within Bank of Ireland, and as part of our audit of Bank of Ireland, we would consider the governance in place in the context of the financial statements, and one of the key risk committees, as I said, is the GRPC. So we would look at the minutes of GRPC. Yes.
But to what purpose did you look at the minutes? Say, for example, in these minutes where it expresses a number of concerns about exposures.
We would look at the minutes in the context, in two contexts. One, to ensure that there's appropriate governance, and it's governance in the context of the audited set of financial statements, to ensure that there are appropriate committees, and those committees are looking at aspects of the accounting statements. And secondly, and another prime focus of our looking at this would be to consider any impacts that these have on impairment. So where these minutes have detailed application to the calculation of impairment, then we would look at them, they would direct our work.
Impairment at that point in time, not
impairment,
future impairment
risks. We're in an incurred loss model, and an incurred loss model is the loss event has to happen, and then it is of consequence for the accounts. If it hasn't happened, it's not of consequence for the accounts because we're not in an expected loss model. So we're doing an audit, and we have to focus on what we're asked to do. And what we're asked to do is look at impairment from an incurred loss perspective.
Okay. And this document then from the Group Risk Policy Committee, or to the Group Risk Policy Committee, it's the end of 2007, and it's noting that 44% of all non-mortgage lending is to property. And when you combine mortgage lending with property and construction lending, it's 70% of the bank's entire loan book. So did PWC ever analyse the risk level associated with the percentage share of the property-related lending?
I think the 70% includes both property and mortgage, if I'm correct. So they'd be two separate risk factors. What we would look at is the risk of material statement. What we would look at is the impairment calculations from the bank and ensure that the impairment calculations of the bank are appropriate to give them their impairment charge and are appropriate to allow us to give a clean opinion on the bank's financial statements. And that's very important. But our reporting in the context of property concentration, in the context of property prices, in the context of an expectation gap between an incurred loss and expected loss, we would have reported on that to the Audit Committee quite regularly during this period, but always in the context of the calculation of impairment, because that's what we were asked to do. So when we look at something that our pure focus is what does that mean in the context of the calculation of a loss, an incurred loss, for the period that we are asked to sign our audit opinion. That's what we look at.
What about the wider concern, though, that's been expressed internally about this exposure, this concentration exposure? I mean, if we go to page 40, halfway down the page, it says, if the Group Risk Policy Committee is of the view that the level of property exposure in the Group's balance sheet is too high, there are relatively few realistic options that could be considered. And it points out a few. I mean, that's a warning from one part of the bank to the other over its concentration exposure.
What it is it's a minute from a risk committee documenting the risk that exists as a result of a bank's lending strategy. What we have to do is audit the balance sheet that arose as a result of the strategy. So the balance sheet is there. We audit the transactions, and we audit the transactions in the context of whether they've been properly measured and recognised in the balance sheet. So we are always looking at it in the context of an impaired loss calculation.
But as it says here, if the exposure is too high, there are relatively few realistic options that could be considered. You as PwC cannot take a view on that in terms of your assessment of the bank's position.
No, because it's not our assessment. As I said, it's not our role to talk about what the bank's strategy was, what its policies were, what options are available to the management of its business. What our job is what loans have they entered into at the year end? Are those loans properly accounted for? And in the context of are they properly accounted for, has impairment on those loans as they exist at the balance sheet, has that been properly calculated? That is our role. That's where it begins and ends.
So in finalising your accounts then for 2007, and this report came in December 2007, you could make no regard to this particular risk being identified, and you could have no concern for the future based on this risk.
No, what I would say is that we considered all risk documents, we considered all evidence available to us in the context of formulating an opinion on the financial statements. Secondly, we would have considered all these documents in terms of the required disclosures. And you look in the financial statement, the sector risk was properly disclosed in the bank's financial sector, in the bank's financial statements, and indeed the funding model to fund those sector risks was also disclosed in the bank's financial statements. That's where our role begins and ends.
Okay, thank you.